For more on what's really going on, let's bring in Tom Philipson, former White House Council on Economic Advisors chairman, and Nick Timiraos, Wall Street Journal chief economics correspondent, author of the great book, $1 Trillion Triage, or Triage. I guess it's Triage, right? Nick, good to see you. Thank you for being here. So will this CPI report change the Fed's strategy at all? Nick.
David, no. Thank you for having me. I don't think this, one report is not going to change anything here for the Fed. The Fed has been pretty clear. They want financial conditions to tighten, and they want to keep financial conditions tight. Of course, that is not what happened today. You noted that, there was a boom in the markets, a lot of optimism here that maybe this could be the first of several slowdowns in inflation. And that's what the Fed is going to want to see, David. They're going to want to see a series of softer inflation readings so that they can really have confidence that they've gotten on top of this thing.
Well, you said the last time before the rate hike, which was another 75 basis point hike, you suggested the market was getting a little giddy about thinking that the Fed was going to slow down. You were absolutely right. Do you think the market's doing that right now?
Well, what Fed officials are trying to do is they're trying to separate this conversation around the pace of increases. They're probably going to raise interest rates at a slower pace in December, 50 basis points instead of 75. And so they're trying to make sure that you don't have some sort of broad easing in financial conditions that makes it harder for them to accomplish their goal, which is to push inflation down. And if there's more risk-taking, if investors are, buying risk assets right now, that does not help the Fed bring inflation down, slower hiring, slower growth, slower investment, more saving. And so that's the question here. And last week at the Fed press conference, the chairman, Jay Powell, talked about how the Fed might have to raise interest rates higher than people had been thinking just 2 months ago. So that's the issue here, is how high do you think you're going to go, and not just how fast are you going to get there.
All right. Well, Tom, let's talk about the supply side of the inflation equation, because it's too much money chasing too few goods. We certainly have too few goods out there. Productivity is down. It's down to levels we haven't seen in about 40 years. And when productivity is down, that means that an average worker produces less than they should be producing, and that increases the cost of everything. So the president last night, when he was pushed on this, he essentially said he's not going to change anything on his policies concerning incentives for the private sector. Let me play that and get your reaction. Roll tape.
Overwhelming majority of the American people support the elements of my economic agenda. From rebuilding America's roads and bridges to lowering prescription drug costs to historic investment in tackling the climate crisis, to making sure that large corporations begin to pay their fair share in taxes. I'm confident these policies are working and that we're on the right path, and we need to stick with them.
The right path? We are not producing enough goods. We're not on the right path, Tom.
Yeah, I think there's two kind of pressures going on inflation here that maybe the market reacted to as well. We're getting, more and more confirmation this is going to be a Republican Congress now. That's going to slow down the fiscal overreaction we've seen that led to this problem to start with. So demand pressure is down now with the House being Republican. On the other hand, what that will lead to, it happened the same thing when I was in the Trump administration, there's going to be a lot of regulatory focus now by the White House because they don't have Congress on their side. And if they're going to ramp up their regulations, which is anti-business, that's going to hit supply very negatively, just as it has already. So there's two opposing forces. One are demand cuts through less fiscal activity, but on the other hand, there's going to be supply cuts at the same time, which have sort of opposing effects on inflation.
Tom, I'm sure you remember this or you know this, but Ronald Reagan, when people would say, gee, those tax cuts really worked, when he had growth rates of 3, 4, 7% in 1 year after the tax cuts kicked in, he said, hey, the tax cuts were great, but it was the regulation cuts that really got this economy moving. So if we have more regulation, that's definitely going to suppress supply, is it not?
Yeah, and that's why we, in the Trump administration, we had historic regulation cuts and regulation slowdown. And I think that's underestimated compared to the tax cuts, how much that contributed. I think and on the other hand, you've seen with Biden, it's been historic growth in regulations, not to talk about energy, but in many other sectors as well, which obviously slows down supply. It's a very business unfriendly environment which basically clamps down on supply, which raises prices.
And Nick, it's back to demand now. Of course, the economy is supply and demand. The fact is that the Fed has this huge portfolio, trillions and trillions and trillions of dollars. It started on that path back during the Great Recession of 2008, 2009, and it's been continuing that. Now, it is getting rid of some of it, but nowhere near as much as some people would like. So there's all this money sloshing around. When are they going to pull down put all of the bonds that they're holding into the market and shorten their portfolio?
Well, the Fed has been running down their portfolio by about $95 billion per month, almost twice the pace of what they were doing in 2017 and 2018 when they allowed their holdings to shrink passively. I think, David, what was so interesting about the inflation numbers today was that the Fed, last year they were talking about inflation being transitory, and they were banking on goods prices that had gone up a lot last year coming back down. You finally saw some of that today. You saw used car prices down 2.4%. You saw, household furnishings, apparel, all the things we were out buying last year. Now there's been less spending on those items. You see prices coming down. The big question really is what happens in the service side of the economy. That is a labor-intensive sector, and that's where you could really see either things get better here, and then the market's, overjoyous, sentiment today would be validated, or you could see this last longer, higher inflation lasting longer, and it would be more of a long grind.
Well, Tom, you talk to anybody who's been to a restaurant recently, they say service sector is not improving. The service is not getting better. I mean, that's anecdotal. I understand. It's hard to prove from an economic point of view, but it is true. And I would just push back a little bit on Nick was saying about inflation. Yes, the numbers are down, and it was good to have a good number. Obviously, the markets liked it, but boy, you haven't had a 19.8% month-over-month increase in fuel oil for heating homes, and the diesel. You look at diesel oil, or diesel gas, which is propelling so much of the goods that we use. We still have some serious issues, particularly with energy and inflation, right?
Yeah, I think top-line inflation was a lot worse than core inflation, which excludes energy and food, obviously. And the reason is because core inflation was almost entirely driven by shelter, meaning shelter went out dramatically, housing 0.8, and shelter makes up about 40% of CPI. So it basically contributed 100% to the core CPI growth we saw. Yeah. Now, the point with shelter is everyone knows it's a lagged measure, right? So you should even be more optimistic than that core inflation right now, because that shelter number is picking up what happened in the past. It's not picking up the housing recession we currently have.
Nick, one final point, and I'm running over a little bit, but I got a slight bone to pick with you. You use the Fed's language, or did in a particular tweet, about this cushion of savings that Americans have that should protect them from, to a certain extent, from inflation. I got a lot of notes from people who say, look, we're living paycheck to paycheck. We don't have any cushion of savings. There are some estimates that paycheck to paycheck folks represent about 60% of the families of America. So how would you answer that you can't have a cushion of savings when folks are living paycheck to paycheck?
Yeah, it's a great question. The big question right now is, when does the consumer slow down? And if you've been listening to earnings reports over the last couple of weeks, Bank of America, American Express, United Airlines, Coke and Pepsi, one thing they've all been saying is that the consumer's strong. The consumer's spending. And so you've seen almost 400 basis points in Fed rate increases this year, and the consumer's been resilient. And I think that's raising these questions right now, David, which is, well, if the Fed is tightening that much and the consumer's still standing, then what's going on here? And some people are going to look to the pent-up savings, better private sector balance sheets from the pandemic recovery.
All right, we'll have to have a further discussion on this matter later, but great to have you both here. Thomas and Nick, great to see you. Thank you very much.
Thank you.